Hello, fellow investors, and welcome back to a new video. In this one, I'll be talking about NVIDIA, arguably the most popular stock in the markets for 2023 and 2024. In this video, I won't be telling you to buy NVIDIA. I won't be telling you that this stock is going to the moon. I also won't be telling you that this is a bubble. You know that on this channel, I like to look at companies objectively, trying to look at a company's strengths and weaknesses, and trying to determine the risk and reward ratio. At the end of the day, as investors, we're just trying to make money in the market. And the best way to do that, in my opinion, is to avoid risk as much as possible. Some people like to say that the more risk you take, the better your returns will be. That seems to be the narrative with a lot of people out there, but I completely disagree with this. Instead, I think people should be focusing on minimizing risk, and by doing so, the returns will simply take care of themselves. In investing, the goal is durability. You should aim to get consistently good returns over the longest possible time. And that's the real secret. It's, maintaining those returns for the longest possible time to allow compounding to take hold instead of maximizing those returns over the short term. Because the thing is, while maximizing your returns might, bring you success over a year, 2 years, 5 years even, eventually down the line, maybe year 15, maybe it's year 16, maybe it's year 20. Trying to maximize your returns will lead to a 50% drawdown or a 60% drawdown. You might even blow up your entire portfolio. And at that point, it's just game over. Anyways, that was a little tangent. Back to NVIDIA. This company has been talked about a lot lately. And unless you live under a rock, you would know that this company is basically leading the AI revolution. It's waving that flag in the front line. This is a stock that has even left the domain of Wall Street and has, entered pop culture. I don't know about you, but certainly I have had this experience where a stranger or someone that I barely know, who I wouldn't be talking about stocks usually, mentions NVIDIA in a regular conversation. Now, why would that be? Well, maybe this explains it. This company has had one of the most successful stocks in the market since the mid 2010s. It's had really a meteoric rise to the top. The market cap has simply exploded. I think it's now the third or fourth biggest company in the world, bigger than the likes of Google and Amazon. As you can see, this company pays a tiny, tiny dividend, 0.02%, which allows me to cover this on this channel. So yay for that. Now, if you look at the multiple, the PE of 72 is quite high if you know anything about stocks. If you look at the price to free cash flow, it's even higher than this. I believe it's around 90 at the moment of recording this video. Now, it's true that we always have to respect the market. The company is worth, this much for a reason. Investors are rating it very highly. And usually, when a lot of investors like a company, it's probably because they're right, because it's a really good company that's growing very fast. Maybe they have a really wide moat. So it's important to always respect the market. But as the price of a stock runs up, like it has for NVIDIA in the last 2, 3 years, the multiple expands, which is why now the price to free cash flow is 90. This brings in some extra valuation risk into the picture because the more you pay for a company, the more you're expecting that company to grow into that valuation. So again, what I'll try to do in this video is to quantify the risks and the rewards that are associated with NVIDIA. If you're new to this channel, my name is Camille and I run a stock research and rating platform called Rated A. The purpose of Rated A is to focus on one thing: long-term investor success. And we do this by giving you information such that you can minimize risk as much as possible. Risk comes in two forms: fundamental risk and valuation risk. Fundamental risk comes from the company itself. How do we bring fundamental risk down? Well, you find great companies. We quantify great companies using three components: the moat, the profitability, and the safety. The moat is calculated based on the company's protection from competition. The profitability refers to a company's cash flow generation, the margins, and future growth. In safety, we look at secular trends, we look at regulation or debt or things like that. Now, valuation risk comes from the price that you pay to buy these assets. We combine both the fundamental risk and the valuation risk into our combined risk score. And this gives you a metric that you can use to compare different companies and see which one might actually be a better deal at that moment to buy and hold for the next 10 years. If you like these videos, if you like my work, if you like the research I do, you can subscribe to Rated A. It's free for the first 2 weeks and you can cancel anytime. If your goal when investing is to give yourself the highest chances of being well off in the end, no matter what happens in the world, then you'll really benefit from Rated A. Back to NVIDIA. When looking at a company, the first thing to do is to understand exactly how it makes money. And NVIDIA's story is pretty fascinating with this regard. The company came to be in the early 90s, back when consumer technology was really starting to gain pace, when it looked like personal computers and the internet were going to be mainstays in the future. Back then, CPUs, which stands for Central Processing Unit, were chips that acted like the brain of the computer. They're very powerful semiconductors that are necessary for a computer to function. They process information serially and sequentially in ones and zeros. And while CPUs are super efficient in running programs, they aren't very efficient for a new market at the time that was starting to bloom in the 90s, which is gaming. In gaming, for a good user experience, you need good graphics. Graphics requires several thousands of different pixels to light up at the same time, every tenth of a second. A CPU simply can't process information that fast. So in comes NVIDIA and the GPU, which stands for Graphics Processing Unit. GPUs consist of many more cores than CPUs, and instead of processing information sequentially, they can process it in parallel. So while their cores are much less powerful than a CPU's, they are much better suited to display video game graphics. Up until very recently, NVIDIA made the majority of its money by selling GPU chips for people to play video games on. As it turns out, NVIDIA was standing on a gold mine without even knowing it. Being able to process information in parallel ended up opening doors to so many businesses. For example, in crypto mining, computers need to solve complex mathematical problems. By being able to perform many thousands of these calculations at once, GPUs are just much more efficient and provide miners with higher yields when mining for Bitcoin. Another use case, and arguably the most important use case to date, is running AI algorithms. AI algorithms need to be trained on billions, sometimes trillions of parameters. ChatGPT, for example, was trained using trillions of parameters, at least the latest model. And realistically, this can only be done using GPUs. Today, any industrial algorithm, and whether that be Google search or YouTube's recommendations, your Instagram or TikTok feeds, think about all the advertisements that are made on Facebook and Amazon and all those places. All of it runs on NVIDIA's GPUs. All of the big cloud providers, the Microsofts, Amazon, Google, Meta, Oracle, they're all snatching up NVIDIA GPUs to build out data centers. So when you think about it, data centers require enormous amounts of computational power. But NVIDIA's involvement doesn't stop with GPUs. The company is doing all kinds of things that are revolutionizing the way computers work. To keep it short, they're essentially working on making the entire data center work as one unit, and they're calling this the DPU, Data Processing Unit. And they can do that because of super new technology that can improve memory and communication between different sets of GPUs within the data center. They're also starting to offer cloud solutions through the data center of other hyperscalers. for regular companies to train their own AI models. And the mind blowing thing is what NVIDIA is doing for companies or enterprises, as they say. It's possible to build applications on top of NVIDIA's GPUs, and the company is building some pretty epic ones. For example, for autonomous driving, drug discovery, trading, risk management, and fraud prevention. NVIDIA's also built a literal simulation of the world that they call Omniverse, where companies can improve and test out their processes in a virtual world that follows the same laws of physics as what we have in the real world. And this is where, Jensen Huang in his latest conference, he brought out robots on stage, which was pretty epic. But basically, what he said is, for example, to train these robots, you don't need to build out a robot and train them in a room with obstacles and all that. All you need now is to program it onto the Omniverse, and the robot can train itself. So to summarize what NVIDIA does, they're basically at the forefront of technology. They're at that threshold where between the possible and what's impossible. For now, they mostly sell hardware to cloud providers, to gamers. They have their GPUs, but they've been building applications on top of this hardware, which are usually free, but obviously you need to buy the hardware in order to run these applications. And because no other company makes GPUs as well as NVIDIA, for now the closest competitor would be AMD, they've basically cornered this booming market. And all of the demand has gone to NVIDIA, which is why their revenues and their cash flows have just exploded in the last year. I mean, just look at this chart. The revenue and especially the free cash flow has literally, what is this, 8x'd in like 3 years, 54% revenue growth in the last 3 years. Once again, guys, if you want a more detailed explanation of how NVIDIA makes money, you can get it on Rated A. There's also a full analysis of NVIDIA's competitive advantages and the risks associated with the business model. But for the sake of keeping this video not too long, I'll spare you most of those details. For now, I want to focus on the quality rating for this company. You can clearly see that it's a B rating, but I want to dive into details and see why NVIDIA scored what it did for Moat, profitability, and safety scores. So, when we talk about NVIDIA's Moat, we have to mention CUDA. CUDA is the proprietary software of NVIDIA that works on all of its hardware. It's free to download, it's free to use, but it has to run on NVIDIA GPUs. It's not compatible with any other GPU from anybody else in the industry. So what this means is that similar to Apple, NVIDIA owns its own ecosystem. It owns the hardware, it owns the software, and as you'll see in a second, it owns the developers and it owns the applications. Because here's the thing, NVIDIA brought CUDA to life in 2006, which, thinking about it, shows incredible foresight by management. Because in 2006, nobody was talking about crypto, nobody was talking about AI, nobody was talking about all these futuristic use cases. But NVIDIA actually went out of their way to convince people to learn CUDA and to show people the merits of their new software in universities, which means that newly graduated software developers were entering the workforce with their skills. And companies, they don't want to retrain employees to use a new software on hardware that isn't as good. Because yes, NVIDIA has always produced top-tier GPUs for the scientific computing community. Once you have CUDA being taught in unis and you have companies building entire data centers on NVIDIA architecture, it's very hard to switch to something else. So why is the Moat rating 4 stars and not 5? Well, the thing is, NVIDIA might be a victim of its own success. Competition is really heating up. And that's because NVIDIA is simply too important. It's too good. Big established companies like Google and like Microsoft are paying hundreds of millions, if not billions, to NVIDIA just to, get those chips in their data centers. And when a company with the resources and the know-how like Google and Microsoft is releasing so much value to another company, they're going to try to do everything they can to have their own developers find solutions to this problem. And so at the moment, Microsoft is trying to, build its own architecture for its own use cases. Similar thing for Google, similar thing for Meta. Are they going to succeed? Well, for now, nobody knows. But that's definitely a risk that you need to be aware of if you're going to invest in NVIDIA. And when it comes to CUDA, well, that's also under threat. A lot of established players like OpenAI or like AMD are trying to bring out open ended softwares, which means that they work on any hardware. It doesn't have to be NVIDIA's, but it can be interchangeable. And so that would be great to, kind of liberate that monopoly that is held by NVIDIA at the moment. So, yes, NVIDIA has pretty much a complete monopoly at the moment. But there's a lot of players that are very hard at work at the moment in order to try to displace this monopoly, which is why NVIDIA only gets 4 stars out of 5 for Moat. That brings me to the second point, or technically the third point, which is safety. Notice that I didn't mention technology at all when talking about NVIDIA's Moat. Why is that? I have 4 words for you: rapid innovation and obsolescence. The thing is with technology, and especially semiconductors, which is, the peak form of technology, you need to spend to stay at the top. If we look at Nvidia's capital expenditure ratios, they seem to be completely fine. It's very reasonable. Ideally, we want the capex ratios for revenues to be under 5, and the capex to operating cash flow ratio to stay under 25. And that's been the case for most of NVIDIA's recent history. What's not shown in these ratios, however, is the research and development expenditures. NVIDIA, on any given year, spends 15 to 40% of its entire revenues on research and development. And for the company to stay at the top, this is a necessary expense. In other words, it's a fixed expense. The company has to spend that year in, year out. But this fixed expense comes with very unpredictable results. For every $1 million that you spend on research, there's a high enough chance that you're not gonna come up with anything new. So that's the first reason why technology and advancements is a complicated issue and comes with some risk. But let's talk about the whole AI industry for a second. This is an industry that just a few years ago nobody was talking about. And the company was barely making any money from AI 2, 3 years ago. And if that's the case, and an industry is able to explode all of a sudden from one year to the next, what's going to happen 5, 10 years from now? Who will be the winners and the losers? The point is, nobody knows how it's going to evolve. There's a lot of uncertainty. Let me just give you an example. Training AI models requires lots and lots and lots of parameters. Basically, you have to train the AI on hundreds of millions and billions of scenarios for it to become intelligence. That's called training the model, and it's done really well on NVIDIA GPUs that do parallel processing, that have good performance, and basically perfect for this use case. But once the intelligence and the AI model is trained, then it's time to move on to inference. And inference basically entails having this model use its intelligence to make decisions or to recognize pictures, or in a large language model to give it a prompt and then it comes with an answer. And for this inference part, NVIDIA GPUs are much less useful. And as a matter of fact, NVIDIA doesn't even have a majority market share for inference on AI models. So once again, we don't know how this is going to evolve, which is why NVIDIA's safety score stands at only 3 stars. At this point, I'm just going to breeze through the last component, the one that we skipped over, which is profitability. As you can see, it received 4 stars out of 5. Basically, demand for NVIDIA's chips far exceeds supply at the moment. There's a huge bottleneck at that point in the entire economy. And so NVIDIA is basically able to charge any price that it wants on its chips, and people are willing to buy them. NVIDIA will also benefit from huge secular trends, including the rise of AI and machine learning, and that will probably lead to very rapid growth in the years to come. So why just a 4 out of 5? Well, mostly due to the R&D expenses. And the other thing is the cyclicality of the semiconductor industry. Basically, in times when the economy is doing really well, Companies will spend on new technologies and new processes, but when the economy is not doing so well, these companies will cut back on those expenses. And so, just overall, semiconductor companies are a bit less predictable because they're reliant on economic conditions. So, overall, NVIDIA gets a quality rating of B, which is not too shabby. And this concludes the portion of the video where we talk about NVIDIA's qualities and the qualitative aspects of this company. And we're going to start to focus now on the valuation and the valuation risk. As I mentioned at the start of the video, NVIDIA trades for a free cash flow multiple of 92.5. There's just no other way to say this. 92 as a multiple is extremely expensive. And a lot of the people investing at these prices are probably expecting NVIDIA's revenue to double again for the next 2 or 3 years. If that's the case, then maybe this multiple is warranted. But when you make such assumptions and the hurdle rate is that high, then your investment just becomes a lot more riskier because the base case becomes something that's very hard to achieve. And just as an example, I filled out one set of assumptions for NVIDIA using the total shareholder return calculator. Basically, you input your assumptions into this calculator, and based on your assumptions, the calculator spits out a return that you can probably expect for the next 10 years. So I've already pre-filled all of this. I've put the buy price, today's price, NVIDIA is $880. I've put in the current revenue for 2023. So this is where things get interesting. I put a 25% revenue growth rate, and this is for the next 10 years. For those of you that think 25% is not very high, keep in mind that NVIDIA is already a $2 trillion company. Right now, the current revenue is around 60 billion. If the company managed to grow at 25% for 10 years, this 60 billion would become about 550 billion, which would basically give NVIDIA the same amount of revenue as Apple and Microsoft together combined do today. Let's say that they're able to keep their margins at around 30% like they have been doing these past few years. Assuming a little bit of share buybacks and a final terminal multiple at the end of 10 years of 30. And keep in mind, a terminal multiple of 30 at the end of 10 years for a company that at this point would be worth $5 trillion or $10 trillion is insane. It assumes a whole lot of growth for what would already be the largest company in the world. I've put in the rest of the information about the dividends, and we get, even on this super rosy assumptions, a total shareholder return of 9% approximately. To me, this means that the risk-reward ratio is completely off. These assumptions are super extravagant, and I would never input them into the calculator if I was making an investment. I always prefer to be on the safer side and to input assumptions that might be a little bit lower to what I think the company can actually achieve. And when it comes to the total shareholder return, when I make investments into companies, I like to see at least a 15%, which is around double the market return. And that means that I'm giving myself a margin of safety in case things go wrong. So there you have it. When you combine the fundamental risks, the quality rating, and the valuation risk, we get a combined risk score for NVIDIA of 0.526. This alone doesn't tell you much, but what I can tell you is that there are a few companies that I cover on Rated A that have much better risk scores than this. Anyways, that's the end of this video. I hope you learned something. If I missed something, let me know in the comments below. Let me know what you think, and I'll see you in the next one. Peace.